First off, let me thank you for inviting me here. Until very recently, I was the chief of the China division at the IMF, and I used to get to come to these great conferences on China all the time. I have a lot of really complicated slides that are going to try to make the same point. You can read them in our article forwards. You can go over. Really, the slides are there to tell you that the story I'm going to tell, I'm going to spend most of my time telling a story, is correct. If you don't believe me, look at that complicated slide. It proves. I'm not going to go over all of them. And a lot of what I was going to say has already been said. If you want to remember two things from today's talk, is what's happening in China is the economy is moving to a new normal. This is a good thing. And I'd give this talk without PowerPoints. It's the three S's. Growth is slower, but it's safer and more sustainable. It's good for China, and it's good for the world. I think that's the main takeaway. But I was asked to talk about credit and government debt. But it's actually the flip side of the same coin, building on the previous presentation. Why is slower growth safer and more sustainable? It's because the pattern of growth has relied too much on an accumulation of debt. So moving away from that is going to move us to a better growth path. And depending on time, I may get to some of the technical details, but there's been a lot of talk about credit and government debt. It's risen a lot, but it's still manageable, both on the government side and on the financial sector side. I have a lot of charts that put it in international perspective, as was just done. The second caveat is be careful. There's a lot of double counting when people look at Chinese debt. It makes the total look higher than it is. But those are the main takeaways. This chart may look familiar, including the growth projections. The black line, a little confusing on the right, is GDP growth. The far right are our forecasts. What's the story in China? My real simple macro story is in the late 90s, you had massive SOE reform with 20, 30 million workers laid off. And then China joined WTO in the early 2000s. What a perfect marriage of reforms. Growth in China throughout the 2000s, which was phenomenal. That peaks at almost 15%, was driven by growth in private sector manufacturing, almost all of the growth and all of the employment growth. And there's Nick Lardy at the Peterson Institute has a great book that documents this in much greater detail, but growth was led by reforms, and primarily in the private sector manufacturing. You take a worker from the farm, move them to a factory assembling computers, guess what? You get a lot of productivity growth. That worker's much more productive. That's what happened. That growth model was running its course, and then the global financial crisis hit. From 2009 until present, the pattern of growth in China has relied a lot on credit accumulation. Call it stimulus in one form or another. It works to support growth in the short run, but it's not sustainable. The future, and we have our forecast here, ultimately will depend on how successful China is in reforming itself. Economists like to call it generating new forms of total factor productivity growth. We had a lot of work before on the financial services. I think that's critical. If China can reform the financial sector and reform the SOE sector just like it did before, there it can sustain growth. But our forecast here, which has growth kind of around 6 to 6.5% between now and 2020, is our forecast. It's also what we think should happen, and we think it is a good thing for China. What are these blue bars? These blue bars are China's contribution to global growth. And there's a kind of throwaway thing, size matters. Somehow I think people forget simple math. An economy that's twice as big, but growing half as fast, contributes the same to global growth. China's contributions to global growth are quite similar to what it was before. Even though China's slowing, it's so much bigger that even at 6%, it's still contributing as much to global growth, a point that seems often forgotten. All right, now I'm going to go a little bit into the weeds. So what happened? This blue line is infrastructure investment. This red line is total fixed asset investment. It's investment. Global financial crisis hits in 2008-9. China ramps up infrastructure spending. If there's any Keynesians out there still, nothing better than infrastructure spending to support growth. And sometimes people get confused by the magnitude. This is a 60% increase in investment spending year on year. If you want to jumpstart growth in the middle of a global financial crisis, that's a pretty good way. Growth in China did fall, and it fell broadly in line with the decline in global growth. But why was China still able to grow at 9% in 2009? This is why, 60% growth in infrastructure investment. If we look, the red line is total investment, and the scaling is skewed. Anytime you have a 60, you tend to not notice the thing. The red line is actually coming down. That's total investment. It's gone down from about 20 to 10. Infrastructure investment, however, still continued to be pretty strong. We've seen a lot about this total social financing. This is the stock. Think of it as the stock of credit as a share of GDP. When China had its phenomenal boom, 2000 to 2008, it was not driven by credit. The stock of credit was pretty constant at about 120% of GDP. Financial crisis hits, infrastructure picks up, and you see the black line rising. That was a growth model that was reliant on credit to invest, to support growth. What are the colors? Blue is plain vanilla commercial banking. It's still a predominantly bank-dominated system. Pink is the so-called shadow banking. It's not a very convenient term because shadow sounds kind of negative. A lot of this was actually financial innovation. The top two things that you can hardly see, the green one is the equity market. Equity market, as was said before, is not an important source of financing. These are stocks, not flows. Equity financing is not an important part of financing for China's economy. The purple ones are the bond market. They're growing, but it's still small. It's still predominantly a bank-dominated system. As the previous speaker said, though, when you start to see credit going from 120 to 200% of GDP, as macroeconomists, we get pretty nervous. So we went and looked what's happened in other credit booms. At the IMF, we have I don't know if it's great data, but we have data from all over the world. So we looked at other episodes of very rapid credit growth. And this chart's horribly confusing. What's it telling you? Most countries who had a credit boom of similar size half of them ended up with the banking crisis. Those are the red dots. The horizontal axis is GDP growth. All of them saw a decline in growth, following a huge boom in credit. But here's the good news. This is that same line. This is total social financing, but I'm switching to growth rates. This is year-on-year growth. One of the reasons growth in China has been slowing is that indeed the government has been slowing the pace of credit growth. Those pink bars are the contributions from so-called shadow banking. Much of the slowdown in credit growth has come from a decline in shadow banking growth. This is the same version of a slide we just saw on financial deepening. Some of that increase in credit we saw in China was actually a good thing. It was just China financial markets deepening. Horizontal axis here is income per capita in US dollars. The vertical axis is your share of credit to GDP. Why is that number not 200? Anyone who's real astute is that we've removed what we consider to be government debt from the numbers to get a number that's more comparable internationally. So credit looks high for its income level, but not off the charts high. Basically, a lot of the financing China did was these LGFVs. What are these? These are off-budget entities that were borrowing. They show up in the credit numbers. And I'm going to fly through this part because it could take me an hour, and I think people still don't get it. We have a working paper on this. In our last several Article 4 reports on China, we have an annex in the back, if you get to page 100, that documents in great detail how we calculate these numbers. But we had a young economist, Sophia Jiang, who miraculously, working alone, came up with a very similar number that about 30,000 auditors in the National Audit Office in China came up with. So we were pretty close. This is our measure of the deficit. It's about 10% of GDP on the black line. The kind of point of this chart is the red line is China's official budget deficit, and you don't actually see a stimulus. If you go back to 2008, the official budget deficit hardly moved. At the IMF, we make some accounting adjustments. When we report general government deficit, that's the blue line. From the blue line to the green line is our estimate of the amount of off-budget activity that was really recorded in the financial system but should have been recorded as fiscal activity. Why is it shaded? Because its green line is sort of a lower bound to the deficit. The truth is somewhere between the blue line and the green line. We can't tell year to year. We don't know how much of this local government financing activity is commercial and how much is fiscal in nature. If you're building a toll road, some of that's commercial, some of it's not. So that shows the uncertainty. The gray line has to do if you add land sales. Just 2 more slides. We like them really confusing. This is the deficit, net lending and borrowing, is on the vertical axis. The horizontal axis is debt to GDP. We have a lot of uncertainty about the deficit. The black line, China's deficit could be quite big by international comparison if you take the bottom line. It could be quite small if you take the official line, but any way you cut it, the debt, this is going on the horizontal axis. China's government debt, even adding all of the off-budget stuff, doesn't look that high by international comparison. Let me end on this slide, which was picking up on the previous speakers. Economists like to decompose growth into you can add labor, you can add capital, or you can use it better with total factor productivity growth. Look at those blue bars are total factor productivity growth. That's the farm to factory story. China's growth was driven incredible TFP growth. Financial crisis hit, the dominant thing driving growth is the pink. What is the pink? That's capital accumulation. That's exactly what Steve was saying before me, right? Growth was relying on adding the capital. Going forward, through reforms, China has to boost the blue bars again. How do you boost total factor productivity growth? It's through structural reforms. It's through reforming your financial system. It's through reforming SOEs. We talked earlier about the legal system. I don't think China's growth hasn't been a miracle. It's come about because it's done the reforms. Just like its past success reflected reform efforts, I think its future course will depend on how successful it is in doing reforms. Thanks.